Hi, this is Victor. I wanted to go over my recession investing strategy, and hopefully it helps you organize what you're going to do over the next 5 years to really make sure that you have a really good strategy to both get your short-term returns and your long-term returns that you want. Not here to convince you that we're in a recession, but the GDP report for the first quarter of 2022 came in that we were negative GDP. And all we need's the second quarter to register a negative growth, and we will be in that recession. Additionally, the Federal Reserve is really trying to fight inflation. So I think their increase in interest rates are basically going to either continue the recession where we've already started, or it's going to induce a recession in the next, let's call it 6 to 9 months. It's just we can't avoid it because too many things are coming together all at once. So let me share with you a few graphs to kind of go over the history of recessions and how I'm going to organize to really take advantage of the recession, not be a victim in the situation. It's actually a great opportunity if you're a long-term value investor. It's a great opportunity, and I'll go over that, and hopefully you pick up a few ideas that you can use in your overall plan to increase your wealth during this down cycle. So first, let's go over the history of recessions. So recessions have been happening pretty much for the last 100 years, and each recession comes about. We have low growth. The market tends to go down during that recession as fear goes into the market, and then it recovers. So if we study the most recent recession that was a natural recession, I consider is the 2007 through 2009 recession that was led by the subprime mortgage market. That was a pretty good recession, but it didn't affect certain industries. It certainly affected housing. It affected certain industries, but other industries flourished. And overall, once we got through that, it was a really nice long-term recovery cycle. Before that, the dot-com bubble, it really affected tech stocks that were overvalued. And I'm the first to agree that, yeah, tech stocks were super overvalued at that time. And it went down considerably for some time, and then it recovered really well. And in here, let us not forget, was 9/11, right? We had 9/11. It was a terrible day. And I remember the markets really collapsed the days following 9/11. So we have a lot of, negative news and fear that existed then. And prior to that, my adult life has really been, a part of this era. So I'm going to stick to this era because I remember firsthand what was going on. Now, we had a really short recession induced by the pandemic. COVID hit, and as you would expect, this is a global pandemic. It's killed, I think, close to 1 million people in the US, which is a lot. And it really it stopped the economy in its tracks for a good reason. Airlines couldn't get people on their airplanes, cruise ships couldn't get people on their cruise ships, and on and on and on. So that was a recession that hit us, but the Fed really pumped money into the economy, lowered interest rates, and especially some industries just flourished during the recession, and even to this day. So let me move on to the next slide and show that the recession that happened at the beginning of 2020 due to COVID, it certainly affected the market. Here's the S&P, and the market went down considerably, but look at that rise. And the market pretty much went from the low point being, 2,300, and the high point was 4,600. So it pretty much doubled in value in 2 years. So that was just incredible. And now we're beginning this recession. You're seeing the downturn that you would see in recessions like this one here. And, what are we going to do about it? So there's two viewpoints of it, right? I continue to think if you do your homework on companies, this is actually a discount on really good companies. So it's an opportunity for me. I don't view it as oh boy, we're going to have to deal with a recession. We've dealt with them before. We're the United States of America. We have innovation. We have hardworking people. We have people that have a desire to make their lives better. So that's just going to get us through this recession. In 2-3 years, we'll look back and say, okay, we're out of this thing, and now it's time to really grow. So how could I use these discounted prices to my advantage? All right, so the short-term horizon, this is, what do I need over the next 2 years? And this is kind of an inventory, and really what is an inventory of opportunities that exist in the short term. Let's go over needs first. Needs, income, got to support myself, my family. What are those short-term needs? Like I've got a son that's going into college in the fall. He'll be a freshman. I have a son that just graduated college. So don't need to pay for the older son, but I'm going to begin to pay for the younger son. Got that all saved up. That's all set for him. But that's an example of needs that I'm going to have and income needs that I'm going to have. Do I have any, milestone purchases or cash outlays that are going to come up? Is my wife's car, about to go? So I'm going to need to get a new car, and I'll need to pay for a car, that kind of thing. Or, am I looking to buy a new house? I'm not looking to do that, but that's an example as well. And then short-term needs, I would put this in the category as well, which is, take care of your mental health and manage your stress. Some of these weeks and some of these moments, the losses are pretty bad, and they can really get to you. So having money, I think, put away in super, risk-free or very low risk investments, you could always have that. And I have, bonds, and I have cash, and I have certain things that don't go down when the rest of the market's going. So that helps, for the stress management, that no matter what, next 2 years, no problem at all. Really, next, 2 to 3 years, the market can really go down significantly, and I'm going to be fine. So that's part of the mental health stress management aspect of the plan. Now, the risk in the short term, stock prices have fallen in 2022, and we would all hope that, the volatility, especially to the downside, is behind us, but I don't expect that. I think 2022, 2023 are going to have some severe, downturns in stock prices, and we're in for more volatility, storms to come. So that's certainly a risk out there. Bad news on companies, it's really magnified. Netflix is a good example. I didn't own Netflix before the bad news, but holy smokes, man, a little bit of bad news in that company, and the stock price went down more than 70%. And it got to a point where it was so undervalued that I ended up buying into Netflix. And there's other examples out there where, the bad news just torpedoes companies. So if you're owning a stock and it gets torpedoed like that, it can really take a lot of wind out of your sails. So really monitor for bad news out there and try to prevent being too overinvested in a company that's going to be hit hard. Big losses at a bad time, right? Again, if we take care of our short-term needs, if I take care of everything that can possibly come up from an expenditure standpoint, big losses won't hurt as much. They'll still hurt, but the combination of a big loss at a bad time, like, hey, I got to pay for tuition and I just had huge losses. Am I going to be short for tuition? That's not going to happen to me. I've got it all covered, but that's an example there that I've got to consider. Is there anything else out there that I have to really take into account and make sure that I have it completely covered? Opportunities in the short term. If you really want your cake and eat it too, meaning in the short term, you want to make sure you have a good return. It always starts with a lot of analysis, studying, and measuring your returns monthly. Studying and analyzing companies other than your time and your internet bill and your electricity, it doesn't cost anything. So doing all that really good analysis, intrinsic valuations, studying companies, study multiple companies in an industry, understand who is going to be the better company, who's the better company to invest in. So really that diligence that you do in a company, it's more important right now in a recession. and especially for your short term. Some of these companies going down are really good lessons for us. I was hit pretty hard on the Facebook or Meta, devaluation. And I didn't quite understand why, investors are freaking out over the company. I still believed in it, and I'm continue to buy more shares on down weeks. But that's an example of, you got to make sure you study the companies. So when those downturns happen, you are comfortable in those positions. In the short term, you want to look at investing in companies that are really stable and pay dividends. Those companies won't lose much value, and that dividend feels good when it's paid out to you. It could be, a week or a couple weeks in a row when the losses are pretty significant. And when a company pays you a dividend, it's sure good psychologically that, hey, there's some money flowing your way. And in fact, your dividend rate gets even better as the stock price goes down. The other opportunity for short-term, returns is bonds. I've got a bond portfolio going. It's doing really well. In certain conditions, and I would say it happens a fair amount. When stocks go down, bonds go up in value, and bonds have a better, income stream than dividend stocks. So that's part of my repertoire over my short-term horizon. And I'm glad I'm doing that, because it's building my skill set for, my later years as I look to retire and want a really steady stream of income. I think the knowledge and the experience with bonds is going to help me always have a really good short-term plan. Now let's look at the long-term plan. Now, as I listen to other investors and analyze what they say and kind of process what they say, I think the long-term mindset is overused. Literally, some investors feel like, hey, short-term losses don't mean anything. I'm a long-term investor. You got to, think that you're going to invest in a company forever. And I understand the philosophy of it all, but I'd rather have a really good company that does well in the short term, medium term, and long term. And my long-term horizon is definitely the most important part of my investing strategy, because I'm not near the time of retiring and really depending on my portfolio. But I want to be an active value investor, and I want to hold myself accountable for the investments I make on a monthly basis. So my long-term horizon definitely looks at long-term opportunities that are going to give me big returns and able to have a really sound retirement. And I do my legacy planning. I want to have a good legacy plan for my boys and be able to help them. So that's part of my overall plan. And my goals are really oriented around, taking care of my family and having a good legacy plan. And I want to make sure that I'm on that right course, right? So I don't want to kind of set it and forget it and say, okay, that's a company I bought and I'm not going to look at it for 10 years. That would just be completely foolish. But I hear other investors, talk about their philosophy. I don't think they mean it this way, but it sounds this way, that, hey, they'll buy a stock and no matter what, they're going to keep that stock forever. And I would say, well, maybe. I definitely have stocks that I've held for more than 20 years. Chevron's an example. I've owned Microsoft for a long time. Now, there's a few stocks like that, but most stocks I'm analyzing and I might own for a few years and then sell off because either they hit a target price or they just became too valuable. Like Apple, I owned Apple for some time. It became too valuable. I couldn't justify the price and I sold it. So that's part of my mentality, is I'm an active value investor. I don't believe in, hey, I'm going to buy that company and own it forever. Warren Buffett, by the way, as I observe, he doesn't own stocks forever either. He's getting out of Verizon currently, which is interesting. And he's gotten into Apple more recently. We'll see what he does with that. But he gets in and he gets out of companies. There's a few that he stayed in for a long time, like Coca-Cola and his railroads. But if you look at what's probably done the best for him recently, those are the investments he's made more recently. So the risks that are out there for a long-term plan really are that a company won't perform well over the next 5 to 10 years. So we got to monitor to make sure we're not sitting on a stock that's just going to be dead weight. We got to analyze companies regularly and make sure that, hey, they're still part of my long-term strategy. They're a good company to own. The market may not recognize how important they are, the value they bring, but man, cash flow is my favorite metric. If a company produces a lot of high cash flow and they keep growing their company, boy, that's 99% of my valuation right there. I'm going to be good with that investment. If they have a really good plan, but need to use that cash to put into capital, I'm good with that plan too, if it makes sense to me. We also have to look out for risks that there's a fundamental change in the economy or the industry they operate in. COVID's a good example. Now we do a lot of distance meetings, right? Zoom meetings, virtual meetings, education. Kids and adults are educating and learning online. So the education industry has changed quite a bit in the last 3 years. I think our travel has changed over the last 3 years, and there's winners and losers when that changes. So you want to make sure those fundamental changes don't affect the company, or if they affect the companies that you're invested in, it helps them, but it's not going to hurt them because they may change your valuation altogether if something significant like that happens. So we got to monitor for that. And the other risk is that if you're a long-term investor and you kind of like just leave your investments unattended without enough diligence in them, you stay on the wrong path too long. And then you go, whoa, I should have changed 5 years ago. So there's a risk there on our long-term plan if you don't do your homework. Opportunities. So starting with, the analysis, studying, and measuring on a monthly basis is the opportunity on every single company that I own. I do that monthly. I study the company. Quarterly, I do a full valuation, make sure that I understand that company and I have a clear opinion on what that company is worth. So that continues. And the opportunity on a long-term basis is to invest in companies, for me, that I believe that they have the best ideas and they will lead the respective industries. So I'm thinking like Facebook's a leader. Google is a leader. Chevron is a leader. These are leaders in their industry, and I'm betting on a very consistent winner when I'm making that investment. So it's a great opportunity to buy into a company, wake up 10 years from now, and the company's worth 3 times as much money as the money you have in the company today. That's the opportunity. And the opportunity, when it's all said and done, is really to achieve doubling of your net worth every 5 years. The rule of 72 applies. Divide 72 by the rate of return in your portfolio, and you'll end up getting, if you want to get to doubling your portfolio, you have to do basically 14.2% return per year. And to do that, you have to be in the right stocks, in the right investments, and you will double your net worth every 5 years, if not better. And, that'd be great to double your net worth every 5 years, and you would be quadrupling your net worth every 10 years. So that's the overall goal for me in my long-term plan. And these are the needs, the risks, and opportunities that I am evaluating as I set my course. All right, so I hope you enjoyed the video, just to share with you my investment strategy for this recession. Again, I believe we've started the recession, especially in some industries. The recession's pretty profound, and like retail has been hard hit recently. Consumer discretionary product companies are being hard hit. That's another example. And but it's not, a recession is not completely a negative. It's an opportunity to buy at discounts. It's an opportunity to buy companies in 2022, 2023, where in 5 years you'll wake up and you doubled, tripled your money. And that's really exciting to me. But it takes a lot of hard work, studying, diligence, making sure that I'm in the right investments. Do me a favor and like my video. Give me comments on this video. This is kind of like the first one of the type. I'm going to be recording videos on the recession and calling out, what I'm doing. And hopefully it helps other investors. If you hear my point of view and what I'm trying to do, it helps you either confirm that maybe you're on a similar plan, maybe drive new ideas. But I'd really love to get your comments and just improve my videos overall. Consider subscribing if you like the content, and good luck investing in 2022.